The first Bitcoin futures exchange traded fund starts trading Tuesday. So, what to know before adding it to your portfolio? So, the first US Bitcoin futures exchange traded fund launches on Tuesday, a milestone for the cryptocurrency industry. The Pro Shares ETF will provide exposure to Bitcoin futures contracts, the agreements to buy or sell the asset later for an agreed upon price rather than Bitcoin itself. While there's strong demand for the new asset, financial advisors urge caution before adding Bitcoin futures ETFs to portfolios. So the first US Bitcoin futures exchange traded fund will launch on Tuesday, blah, 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 blah. Blah, 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 blah. So the ETF presents a disruption to what is available in the marketplace today, said Karan Sood, CEO and Managing Director of Cboe Vest, a financial advisory platform in McLean, Virginia. That's what investors are excited about. So currently investors may buy Bitcoin through digital currency exchanges, but there are safety concerns as some worry about hackers or losing so-called private keys which provide access to their assets. Another option, Bitcoin Trusts, offer an easier way to add Bitcoin to portfolios through brokerage or retirement accounts. But these assets may come with higher fees and values may not mirror the digital currency price changes. So while Bitcoin futures ETFs don't offer what the industry eventually wants, funds that invest directly in digital currency, it provides another choice as companies vie for the green light from the Securities and Exchange Commission to launch regular Bitcoin ETFs. So the price of Bitcoin jumped more than 2% on Monday to $61,958.24 according to Coinmetrics. Now there are a few things prospective investors need to consider before piling money into Bitcoin futures ETFs, financial experts say. Although the funds may have a very high correlation with Bitcoin, the asset won't mirror values of the digital currency because it tracks the price of future contracts, Sood said. Moreover, it costs more to own funds over individual assets, but some investors are willing to pay more for an ETF's institutional level liquidity, custody, and execution versus managing the currency themselves, he said. Still, some advisors see digital currencies as a speculative asset and say bidding on prices of futures contracts can be unpredictable. It's just the ultimate risk that you would ever take, said certified financial planner Jordan Benold, partner at Benold Financial Planning in Prosper, Texas, explaining how the volatility of Bitcoin paired with futures contracts may be a gamble. You're really into high-stakes poker at this point. Bitcoin's value comes from supply and demand factors of an unstable and unpredictable group of market participants, making it inappropriate for an investment portfolio, said CFP Anthony Watson, founder and president of Dearborn, Michigan-based Thrive Retirement Specialists. However, someone's retirement savings and other goals are on track and they have fund money they want to invest in Bitcoin futures, some advisors wouldn't discourage a minimal amount of experimenting. I would just say do it on a very, very small scale, Benold said. Dip your toe into the water. And here's the thing. I have to agree with this statement. And the way to really think about it, right? One, it would be much better to invest into the actual asset than an ETF because you want direct exposure to something that you actually want to invest in. So if you have an interest in Bitcoin, just buy some Bitcoin, right? Like that is the simplest way to go about it. Doing it, just buy it and forget about it, right? Now, another thing to really understand as well, right, is that if you have an interest in cryptocurrency, don't put all of your eggs in one basket. What we mean by this is that like you want cryptocurrency to be on like the lower end of like your portfolio for like just keeping like diversity, right? Like you can't really ignore cryptocurrency now in terms of like an asset class, right? There's just too much money in it. That being said, you don't want to like refinance your house, take the money out and then put it all into like cryptocurrency, right? Like that is dangerous, right? You don't want to stick your whole life savings into cryptocurrency, that is potentially dangerous, right? But what you could do is, let's say that you have your money correct, you have a very strong financial foundation, meaning let's say that you are out of debt, you basically have a pretty, understandable budget, meaning you're not like living paycheck to paycheck, right? You have some excess cash, you're already investing towards retirement, you already have an emergency fund, right? After all that, you have some like extra cash, kind of like fun money, like this person said, fun money, play money, right? Where if you were to lose this money, it will literally not matter to you. Meaning you can literally take whatever money this is, go into your driveway or your front yard or whatever, light it on fire to where it's literally worth nothing, and it would have no financial impact on your life, right? Like it will not change your lifestyle at all. If that's the case, then yeah, go ahead and like invest your money into like cryptocurrency or things that you like, right? Or let's say that instead of, going out to eat on the weekend, you have more of an interest to putting that same amount of money into cryptocurrency. I don't personally see anything wrong with that. The only thing is, when it comes to investing, other than like very like conservative investments like an index fund in the form of like following the S&P 500 or like mutual funds that do basically the same thing, they have a proven track record of like 10 plus years of like getting a return of like 10 to 12% if it's not like real estate, all that kind of stuff, right? Be a little bit more cautious when it comes to things like this because there's just more volatility, meaning there's more of a chance for something bad to happen. And when something bad happens, the effects can be a lot more drastic, right? Now, if you want to go like really fun money, which I don't necessarily suggest anyone end up doing this, but if you don't have a lot of money in terms of the fun money to work with, the smaller cap cryptos could potentially have like massive returns every time Bitcoin ends up doing well. That being said, it also goes the opposite way, right? So if you end up like, for example, like if you end up putting your money into something like Shiba Inu, right? Back like a year ago, right? If you put that same amount into Bitcoin, right? The amount of money that you would end up making is vastly different. You'd make way more money in something like a Shiba Inu than basically a Bitcoin, right? Just because of the volatility that is available to each one, right? But it's just something to really think about. And yeah, if you want to learn how to get out of debt so that you can be in the financial position to put fun money into cryptocurrency without really any risk to yourself, go check out 40inbox.com.